Good morning, good afternoon, good evening, ladies and gentlemen. Welcome once again to our episode on the investment world. So this is a continuation. So we're going to look at the determine your risk tolerance. This is the fourth video. So we're going to look at how you can determine your risk tolerance. So in the case of risk, really, it's being flexible, adaptiveness as well, to different times. So you have to become adaptive. You have to be flexible, really, and try to go along with the new time or the time as well. So in the case of risk tolerance, like it can be affected over time due to change in your circumstances, let's say in your financial situation or the goals or just in market conditions. So all of those things really can affect your risk tolerance. How much can you cope? How much can you take? Really, how far can you go? This is what we're going to determine on risk tolerance. So in this case, we're going to look at the assess your emotional comfort with risk. So that would be number one. Assess as in assessment. Assess your emotional comfort with risk. Number two, we're going to look at the evaluate your financial situations. So evaluate is all about examining, really going over and over to evaluate your financial situations. Number three, we're going to look at the risk tolerance questionnaires and tools. So the questions which you can ask yourself, really trying to assess yourself going over and over. Number four, we're going to look at the aligning investments with risk tolerance. Then number five, it would be adjusting your portfolio over time. So portfolio is simply just financial investments like the stocks, bonds, commodities, and other assets, or in the cryptocurrencies, the ETF, exchange traded funds. All of those are like the financial investments, really. And then after that, I'm going to give a quick summary like I usually do in all the videos, just to understand what the video is all about or what we learned throughout the video. So are you ready, ladies and gentlemen? So tighten your belt. Let's tighten our belt and let's begin. So this is the fourth video, just as I said, determine your risk tolerance. So understanding your risk tolerance is a crucial step in developing an investment strategy that can align with your financial goals and comfort level. So when you understand yourself, really, this is when you try to find the goals or the financial goals and to achieve your financial goals and the comfort level as well, while keeping calm. So risk tolerance refers to the degree of variability in investment returns that you are willing to withstand. So here I'm going to give I'm going to assess and manage your risk tolerance effectively. We're going to go through this together. So in the case of risk tolerance, really it's just like adjusting your strategies as your circumstances or market condition changes. So different circumstances, different market conditions, and you have to change as well, adapting yourself according to the time. So if the time change, maybe if you're too cautious, you can change to become more adventurous. If you're more adventurous, you can change to become more cautious, depending to the market changes or different circumstances or market conditions. So number one, it will be access your emotional comfort with risk. So we're going to look at understand your reaction to losses. How are you going to react when you lose? In the case of investment in stocks or bonds. So consider how you will feel if investment lost value. So in the case of risk tolerances, really, or your reaction to losses, you have to consider how you would feel if your investments lost value. How would you feel? How would you react, really? It's all about your reaction. It's all about resilience, really. How strong is your foundation? So would you be comfortable waiting for the market to recover? Or would you panic and sell? So your emotional response to losses can indicate your risk tolerance. The example, so I'm going to touch on practical examples as well, just in case you might get lost along the way. So the example, like if a 10% drop in portfolio's value would cause significant issues or lead you to sell your investments, you may have a lower risk tolerance. So in this case, this example is simply telling you, like, if there's a 10% drop in your investment, let's say in stocks, bonds, or commodities, will you be anxious, or it will lead you to sell your investments, really? Start selling because there's a high drop, 10%. So if you'll sell, then you may have a lower risk tolerance. That means you cannot hold it, really. So we're going to look at the review past investment behavior as well. So review is like going over it again. Review past investment behavior. Reflect on any past investment experiences. How did you react to market downturns? Did you stay calm or feel the urge to make drastic changes to portfolio? Did you stay calm, or did you make any dramatic or make any just exaggerated changes to portfolio, your financial investments? So this can provide insights into risk tolerance. So look in your past as well, how you reacted, and use that in the present on the next investment really. So consider financial goals as well. So align your risk tolerance with your goals. So long-term goals may allow for more risk. In long-term, you might go for stock, like as you have more time, you have time to recover from market downturns. So short-term goals, however, may require more conservative investments to protect your capital. In the short term, really, you want to protect the capital, which is like conservative investments, which are different from the long terms. So in the short terms, you can go for bonds. In the long term, you go for stocks. Now we're coming to the second point. Evaluate your financial situation. Evaluate or examine your financial situation. So income stability. So if you have a stable income and a secure job, you might be able to take on a more risk, since you can continue investing even during market downturns. So if you have a stable income really, and you have a secure good job as well, or career, so you might be able to take on more risk, since you can continue investing even during market downturns. So in the market downturns, that's when you have to keep considering really, can you keep up? So on the other hand, if your income is irregular or uncertain, a more conservative approach might be appropriate. The example, let's say for example, someone with a steady job and consistent savings might be comfortable investing in stocks, while someone with a fluctuating, changing up and down income may prefer bonds or dividend paying stocks. So bonds are like dividend paying stocks, which are fixed interest really, or fixed assets at an interest rate. So the time zone as well, time horizon, like in the case of time horizon, your investment time horizon plays a significant role in determining your risk tolerance as well. So if you have many years until you need to access your funds, like for example, for retirement, let's say you're still 30 years, you want to retire at 60, the example you gave in the previous video. So you've got 30 years time span before your retirement, so you can afford to take on more risk. So a short time horizon may necessitate lower risk investments. Let's say for 55 or 50 years old man, he has got only short time before retirement. So in his case, you have to consider time, like short time horizon. You have to, or maybe the lower risk, like instead of investing in stocks, it would be advisable to invest in bonds for older people, or more advanced, really 55 or 50. The example, let's say if you are 30 years and investing for retirement, like your long-term horizon allows you to invest more aggressively in stocks, because you still have more time really before your retirement. So however, if you're saving for down payment on a house in 2 years, just in 2 years, that will be like a short-term goal. So you might choose safe investments like bonds or cash equivalents. So in the case of short-term, you actually go for safer bonds or safe investment like bonds. Emergency funds as well. In the case of emergency funds as well, we're still under number 2, evaluate your financial situation. So in the case of emergency fund, like having an emergency fund can give you the confidence to take on more investment risk. So we said like having 3 or 6 month investment before going saving before going into investment. So knowing that you have a financial cushion for unexpected expenses reduces the pressure to sell investment during market downturns. So in the case of risk tolerance, it's all about how much can you cope on. Are you really impulsive when the market downturns, or when the market goes down? Are you also going to selling, and buying? We said selling and buying is not recommended because you have to think about the taxes as well. So in the case of emergency fund, for example, if you have 6 months worth of living expenses saved in emergency fund, you might feel more comfortable investing in volatile assets like stocks or cryptocurrencies. So we said cryptocurrencies like Bitcoin or Ethereum, they have higher risk than the stocks, or stocks have higher risk as well than bonds and mutual funds as well. So number 3, point 3, we're going to look at the risk tolerance questionnaires and tools, the questions which you have to ask yourself. So use online risk tolerance questionnaires, that will be first option. Like many financial institutions and investing platforms offer risk tolerance assessments. So try to assess yourself, really. Try to go through the questions. You have to be true to yourself as well, answering them without lying, really. You have to be true to yourself, in this case, authentic. So these questions or questionnaires ask a series of questions about your financial situation, investment goals, and emotional responses to market fluctuations to help determine your risk tolerance. We say market fluctuations when it goes up and down, up and down. So in the case of marketing, you have up and down, up, rise and fall, rise and fall. So the example of risk tolerance questionnaire, it will be like a typical question might ask you, would you react if your investment lost 20% of its value in a short period? Imagine the 20% drop in your investment. So your answer helps gauge your willingness to take on risk. When you answer that, being authentic to yourself as well, true to yourself, it will help you gauge your willingness to take risks, knowing higher risk, medium risk, and moderate risk, and higher risk, or short-term goal, medium-term goal, and long-term goals as well. So you have to ask all of those. You have to go through the questionnaires. So consider professional guidance as well. That might be good advice. So if you're unsure about your risk tolerance, consider consulting a financial advisor. You can ask a financial advisor as well, or go to your bank. You ask them for advice. You want to invest. You want some investment advice or consultation. Then they can offer free advice. So you can book if you want to pay them as well, because you're taking the time. So in the case of business, they say time is money. So that can help you evaluate your risk capacity and recommend a portfolio that aligns with your comfort level and financial goals. In the portfolio, just the financial investments. So it's like picking, are you going for stocks? Are you going for bonds, mutual funds? Are you going for ETFs, the exchange traded funds? Or are you going for commodities, or just the cryptocurrencies like Bitcoin or Ethereum? So number 4, we're going to look at the aligning investments with risk tolerance. So aligning your investments really with your risk tolerance. You already know your risk tolerance. Now you want to align, you want to choose the best investment for you. Is it stocks? Is it bonds? Is it commodity, the one, or other assets? So low risk tolerance. So if you have a low risk tolerance, you may prefer conservative investments like bonds, fixed income securities, and dividend paying stocks as well. Those are good for those who have lower risk tolerance. So these investments typically offer lower returns, but come with less volatility. It comes with less market up and down because they are fixed interest rate as well. There's lower risk, but which the return as well is lower. It comes slow. So the example, like a portfolio with 70% bonds and 30% stocks. So bonds is more secure. You put more, like 70% on the bonds and 30% on the stocks. The stocks have higher risk, but lower higher risk and the higher return as well. So it might suit someone with a lower risk tolerance, focusing on preserving capital and generating steady income. So in this case, because of lower risk tolerance, you have put 70% on bonds and just 30% on stocks, on the higher risk. So moderate risk tolerance. So if you have a moderate risk tolerance, which is like the balance, equilibrium, so you're not too impulsive, you're not too adventurous, you're not too cautious as well. So just like in the middle, really, you don't react too much, or you don't get mad as well. So you might be comfortable with a balanced mixture of stocks and bonds. So say 50-50, 15% in stocks and 50% in bonds as well, investments in bond. So this allows for growth potential while still providing some stability. So in the case of stability, it's all based on the bonds, which acts as a backup as well. In the case of stocks, there's higher risk and a higher return as well. In the case of bonds, lower risk and lower return. So the example of those who are moderate risk tolerance, like a 60-40 portfolio, let's say 60% in stocks and 40% in bonds as well. So 40% acts as a backup. So it's a common choice for those with moderate risk tolerance, offering a balance between growth and preservation as well. For those who have higher risk tolerance, the people don't care, the people who are adventurous, the people of daring, taking risk as well. If you have a high risk tolerance, you may be willing to invest in more volatile assets like stocks, emerging markets, or cryptocurrencies as well, Bitcoin, Ethereum. So this investment have the potential for high returns with increased risk. A return, increased risk. So the risk is proportional to high return as well, or the high return is proportional to the high risk in this case. So for example, those who have high risk tolerance, so a portfolio with 80% in stocks and just 20% in bonds as a backup, or even let's say 100% in stock portfolio might be suitable for someone with a high risk tolerance and a long-term investment horizon. So imagine putting 100% in stock, you don't have any backup in bonds. So in this case, you have to consider maybe you're focusing in the long term, not in short term. So in the long term, it's like you want to retire at 60, you just 30 years or 20 years. So you have like around 40 or 30 years time span to achieve your goal. So number 5, we're going to look at the adjusting the portfolio over time. We said portfolio just financial investments like stocks, bonds, commodities, cryptocurrencies, the ETFs, which are exchange traded funds, or other assets as well. So those are like the financial investments. So we can look at like reassess regularly or rebalance, reassess regularly, which is good as well. We keep checking, keep examining, we keep checking if there's any change, augmentation. So your risk tolerance may change over time due to changes in your financial situation, goals, or market conditions. So it is essential to reassess your risk tolerance periodically and adjust your portfolio accordingly. So in the case, there might be like a change in your financial situation, you're changing your goals as well, or just any market conditions might affect your risk tolerance. In that case, you cannot stay constant. You keep saying, I'm a high risk taker, I'm a high risk taker. Maybe you can go on lower risk. Maybe you can change to moderate risk really. Instead of saying 100% on stocks, you say maybe 70% on stocks and 30% on bonds as a backup. So for example, reassess regularly. It would be like as you approach retirement, you might shift your portfolio from high risk, stock heavy allocation to a more conservative mix to protect your savings. So you change from high risk to high risk, like in the stock heavy allocation, which are like the cryptocurrencies or stocks. You try to move away from those because you're reaching retirement. So in this case, you go to a more mixed, conservative mix, like bonds as well, mutual funds, or the ETFs, the exchange traded funds, to protect your savings. You can like stay diversified as well, diversified. So like spreading your investment all around. That might be a good advice as well. So don't put all your eggs in one basket. You spread investment all around. So stay diversified. So diversification, spreading all around, can help manage your risk regardless of your tolerance level. So if you don't know whether you're lower risk, moderate risk, or higher risk taker, you can focus on the diversification really. So it can help you manage regardless of your risk tolerance or your risk level. So by spreading your investments across different asset classes like stocks, bonds, real estate, etc., and other assets, so you reduce the impact of any single investment is poor performance. Imagine investing in 10 companies or assets, stocks. So in that asset investments, so in that case, or asset classes, in that case, if this one lose, or if the stock goes down, the investment goes down, or if there's any market downturns, you still have 90% or 80% guaranteed to have your stocks back, or to have investment to input back as well. So the example, if you have a high risk tolerance, diversifying across various sectors, regions, or even regions, not just sectors, even regions, and asset types can provide some protection against volatility. So if you have a risk tolerance, it's not really, you can still diversify, really put across your investment all across the different sectors. Like various sectors, regions, and asset types can provide protection or some protection against volatility. So what can you say in summary, ladies and gentlemen, how to determine your risk? Are you a lower risk taker? Are you a higher risk, or are you moderate? So I said some people are too cautious, some people are impulsive, and some people don't even care. So in the case of like moderate, those are the ones who have already prepared some income or some expenditures, like 3 or 6 month expenditures, before you get yourself into investment. Because this is like gambling, you cannot gamble all your life at the same time. So you have to be patient, you have to go with calculated risk as well. So in your case, maybe you're a high risk taker, like to adventurers, like young people. So you can go for stocks, like cryptos as well. So in summary, we can say like determining your risk tolerance is essential for creating an investment strategy that you can stick with over the long term. So once you determine risk tolerance, that will be essential for creating your investment strategy. You already know what kind of investment you can put on, you can bet on, that you can stick over or with over the long term. So by assessing your emotional comfort with risks, evaluating, like examining really your financial situation, and using tools of professional guidance, you can develop a portfolio that aligns with your goals and risk capacity. But remember, it is okay to adjust your strategy as your circumstances or market condition changes. So you cannot just stay constant really, just stick on what, say I'm higher risk or moderate or lower risk. You keep changing as your circumstances changes as well, or market conditions. So the key is to find a balance, equilibrium. Once you find a balance, that is good. Once you know yourself, once you build it a good foundation, great foundation, between risk and reward, because the higher risk, the higher reward as well, the lower risk, the lower reward as well, that keeps you on track to achieving your financial objectives. So once you're ready, it's all about knowing yourself really. Before getting into investment, you have to know yourself. How much can you take? How far can you go? How far are you willing to go? Or how much are you willing to take out of this? So ladies and gentlemen, don't forget to like, comment, subscribe, and keep sharing the videos. We want to hit 1K and more watch hours as well. Thank you so much. Ciao.